Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is November 20th of 2023. I'm glad everyone could join us. So hope everyone had a great weekend. And before we begin, all of the Life Pro family would like to wish all of our advisors and clients a very happy, safe, and fun Thanksgiving week. Over the coming days, we have a lot to be thankful for as Americans living here in one of the greatest countries of all time, and we're certainly thankful for being in this country and for everything this country gives us. But with no further ado, let's go ahead and get started. So the market ripped last week in the first part. So we kind of think that Tuesday, Wednesday period, we had a pretty aggressive rally following on the prior week's rally, and it experienced a lot of breadth. So we had an upside to downside ratio of 14-1 or so. So that was great to see. And the catalyst for that was the below than expected inflation rate that came in. I believe that was on Tuesday. And so as we all know, over the last 2 years, what's caused this very elongated bear market, especially in growth stocks, really since we go back to February of 2021, it's been inflation, higher interest rates as a result of inflation, and tighter Fed policy. So the second that we saw that, the second that the market saw that inflation report, immediately went into short cover mode, covering shorts on the what we call the most stressed out areas of the growth portion of the stock market. We saw big rips in those areas. We actually saw underperformance, and you saw that in some of our portfolios in areas that would be considered value stocks, so areas that benefited from an accelerating economy and rising rates. So, this week's update is really going to be about, making sure that we're not trying to chase some of those garbage corners of the market and stay focused on some of the long-term theses. And you saw that start to play out on Friday again after the Wednesday and Thursday mean the reversion trade that we saw in the market. So 3 big things that we're going to talk about this week. Can the stock market continue to run? That's obviously a big question. We tend to lean bullish, but we're bullish on pockets of the market, not so bullish in other pockets. Number 2, will interest rates keep falling, right? That's what everyone wants. And certainly if you recently bought a house and you definitely want mortgage rates to fall so you can refinance. Everyone wants rates to fall. We're going to go through why, we need to check our enthusiasm just a little bit there. And then lastly, oil keeps falling. Why? Stocks, believe it or not, have been holding in remarkably well given sort of that price action we've seen in oil. We think there's a reason why there. So we'll go through all of these points this week. So how many trades did we make this week, particularly in our growth sleeves? 0. And there's a reason why we didn't make any trades. And you'll notice we really haven't made many trades recently. It's because we love the portfolio that we have. The companies that we own have very dirt cheap valuations. The growth rates are remarkable. They're well-managed companies. And we really think that the basket of companies that we own with, there's the ability to make adjustments here or there, but the core of the portfolio is really the core piece that we believe has the potential to really accelerate over the coming years as the market realizes the energy shortfalls that exist in the global economy, as well as some of the more secular areas of technology that we're focused on more on the consumer area that we think have a long ways to run before we run into valuation issues. So that's a quick summary there. You get a lot of ups, a lot of downs in the market, but you stay focused on the core pieces that you own. And unless anything has changed fundamentally, we sort of stay put. So 3 big things here. The most shorted stocks have been leading the rally. So when we look at the chart here on the right, the year-to-date performance quintile and what led the most, well, it came from so if we look at the stocks that had the worst performance year-to-date, those were the stocks that rallied the most last week, right? So the bottom 20% of stocks rallied 5.7%, and the top quintile, in other words, the stocks that had the top performance or in the top 20% of stocks, They were only up about 2.9 or 2.8% or so last week. So what does that tell us? That tells us that what we really saw last week was a very aggressive short cover rally. Now, there are little things that happened last week that we think are important, and we'll go through that. But the short covering was the most important thing that we wanted to focus on. Number two, the energy fundamentals are incredible. And I know a lot of people like to scorecard the stocks day to day. We don't do that. We can't do that. What we can scorecard are the just incredible amount of cash flows that these companies are generating. We're talking 10, 15, 20% plus free cash flow yields. Kind of put this into comparison, Google's free cash flow yields are somewhere in the neighborhood of 2%. So these companies are just cash flow machines, and in many cases are trading single digit price to earnings multiples relative to a Google or an Apple that are around 30 times. And then lastly, small caps and banks are starting to show some life. If there's one area that we really thought changed last week, it was small cap stocks and bank stocks. And both of those are really kind of in that value bucket, along with energy and some of the other commodity trades that we've seen that have worked over the last year and a half or so. So that post-inflation rally, when we look at the technical picture here on the S&P 500, we did break above that downward channel resistance. That's a good spot to be in from a technical perspective. The other important thing is that we got another upside cluster day, a 14-to-1 upside to downside ratio. That's very strong. We want to see that. You can see here after other important lows, especially October of 2022, we had 1, 2, 3, 4, 5, 6 clusters of where the advanced decline ratio was up, call it 7-to-1 or greater. So that's something that we really, really want to see. We've had 2 so far. We would like to see a few more. When we look at a more short-term chart of the S&P 500, we did break above that important 4,400 level. Now, a few things, we're fairly overbought short-term. So we've had 3 important gaps in the market. So 42.46, we gapped up to 43.20, we then gapped up to 44.22. The reason why that's important is when you get a little bit short-term overbought and you got 3 gaps in a row like that, you can pull back. And we want to be careful. Again, this is a big theme. We want to be careful that we're not chasing. We're not trying to chase just to try and catch up. We want to stay focused on what we really like longer term. So again, avoid the chase, because that's where you can kind of get burned. And this kind of speaks to this whole notion, right? So let's go back real quick. Overbought right here, 3 gap ups. So sometimes you have to do what's called filling the gap back down. We then have interest rates. This is what spurred the big rally, right? So inflation comes in below expected, boom, boom, big gap down as it relates to interest rates. But now we're kind of sitting right here nicely on 100-day support. And when we look at really what's transpired over the course of the year, remember, we started the year right around 3.88%. So even with the move down, rates are up quite dramatically this year. And if anything, from a technical picture, we've pulled back into the breakout point. And this would be, if you were a technical trader, you would actually buy into a stock that looked like this. So if interest rates were a stock, we would be buying this pullback into the breakout point with a target again of, really trying to get back to 5% and beyond. So that's kind of where our head is at. Inflation, as it relates to that inflation report, we have had very easy math as it relates to the comparisons, because inflation was so high last year that it's easy to get those year-over-year deceleration numbers. Next year, we're starting to come against harder math, where inflation was already starting to decelerate, and where we still see some sticky prices across the economy. So just something to be cognizant of as everyone gets really enthusiastic here about deflation and disinflation. That, remember, inflation is still at 4%, double the Fed's target of 2%. Just something again to remember, we're still at 4% inflation. So why are interest rates so important? Why do we spend so much time paying attention to them? Because if rates are merely pulling back within an uptrend and they're going to resume rising, then we want to look at those quantitative factors that tend to work in a rising rate environment versus a declining rate environment. So one thing is that value stocks have a tendency to outperform growth stocks. So if interest rates are merely pulling back within an uptrend, then what you're likely to see, in our opinion, is that this big rally in growth stocks over the last 2 weeks is merely a bear market rally as it relates to the relative trend versus value stocks before decelerating and turning back lower again as rates reaccelerate upward. So we think that value stocks may resume leadership as rates begin to rise. The other area is that investors have been chasing those expensive growth stocks. They may get burned as they're chasing high levels here as rates accelerate. And then lastly, the small cap explosion that we saw, the explosion to the upside, is actually not so much suggestive of a growth trade as it is more of a cyclical trade, because most small cap stocks are actually relatively cyclical in nature. So when banks do well, when energy does well, when commodities like copper do well, small caps tend to outperform the rest of the market. So that could be that what's happening in small caps could portend a reacceleration in that value trade. And we see that here. The percentage stocks with a 2 standard deviation daily advances about 56% on the Russell 2000, which is, of course, that small cap index. But the question we have, of course, is you need money to buy these stocks. So where is the money going to come from to push this index higher? Well, we think it probably comes from the largest portions of the market, right? So we look here, the S&P 500 equal weight relative to the S&P 500 cap weight is near multi-month lows, right? Just extremely oversold relative to the cap weight. So after a year of extreme underperformance, the question really is, will the average stock and the average small cap stock begin to outperform the miraculous 7 or whatever it was that Jim Cramer came up with another nickname for these stocks, right? Which is your Google, Apple, Netflix, Tesla, NVIDIA, et cetera. If recession risks start to subside, right? In other words, we actually don't really see a lot of recession risk, but the perception of recession risk starts to subside and rates remain sticky and start to accelerate back up. We think that bubble at the very top of the market likely pops and that money flows down the cap scale. So in other words, buying some mid-cap stocks, some small cap stocks, buying value over growth. That's the trade that we're positioned for, because not only is it attractive from a valuation perspective, it's attractive from an earnings growth perspective, and it's attractive from a technical and quant perspective as it relates to rates and inflation. And we see that here. We look at large cap growth leadership, it's increasingly narrow. When we look at now the two largest S&P 500 weights, Apple and Microsoft, make up over 14.6% of the S&P 500. Yes, large growth has been outperforming value, but look what's happening down cap. Small cap growth is actually beginning to break down relative to small cap value. So small cap value stocks are already significantly outperforming. That's led by the banks right now. We really think that area is interesting. And we think that that is a leading indicator for what may happen here with the large growth versus value. As it relates to the bond market, corporate credit spreads have remained healthy. You know, even when we had that sell-off, we didn't see a big widening out of corporate credit spreads. When we look at our income portfolio in particular, when we look at how those bonds are behaving, they really went through the volatility during the month of September and October in great shape. They didn't really move much. You didn't see much of a decline. And right now they offer, I continue to believe, when we look at that portfolio with 6% yields and above after fees, it's just a really attractive strategy for clients that are looking to generate a supplemental source of income relative to their Social Security and annuities and other areas that they might be generating income from. Oil, of course, did sell off. One thing we do want to note here is that whenever we've had these big drops in oil that have been relatively what we call financial driven, you've had big rallies over the next week. And you can see that here in the chart. And you saw that on Friday. OPEC is already starting to, leak some messages out there that they're not going to stand for this. And especially when demand's been healthy and where you've seen supply continue to fall. Now, on the supply side, we have seen inventories rise in the US over the last couple of weeks. But what's interesting is that the EIA also did change the way they calculate inventory. So before it was strictly counting crude oil barrels, they're now including NGLs or natural gas liquids as part of that equation. So yes, naturally inventories did pop because you're including NGLs in that number. Part of us has to wonder if it's a little election year shindiggery going on there. So I wouldn't pay too much attention to these week-to-week numbers. The long-term trend of inventories continues to fall. And just because you start to include NGLs, even though NGLs were already out there, that doesn't change the supply-demand picture at all. And just a reminder as to why we're so bullish on energy, inventories keep dropping as supply dries up, demand for oil growing, US, China, Europe, Middle East, emerging markets, all accelerating at the same time. That major swing supplier is the Middle East. We really do question the sustainability around Iranian production. And then, of course, a structural lack of long-term investment in the ground. We have not seen it over the last decade. Takes time to reaccelerate investment back into the ground. That's counted in years, while demand growth is instantaneous when you get an economic reacceleration. And lastly, merger and acquisition activity in the oil patch is in the very first innings, we believe, and that's going to be a major value driver over the coming months and years. We can see here energy relative to the S&P 500. We think structurally, technically, fundamentally, in the very early innings of another multi-year bull market driven by lack of investment, rising demand, very attractive valuation, and of course, great power competition as the competition between China and the US heat up, competition for strategic resources such as oil and lithium and natural gas and copper. That's only going to continue to increase, not decrease. So bottom line here is don't be the garbage man. Let's not dash for trash at these levels. Be very careful. Someone asked me about SoFi, for example, and I'm like, honestly, I don't know. Like can't figure out how that company or this company or some of these other companies that came public through SPACs, how they even make money. And if you can't answer that question, stay away from it, even if the stock is running, because at some point you get your fingers burned. Number two, interest rates are at important support. We believe that those swing back up. That has an important impact as it relates to what parts of the market rally more than others. And then lastly, oil and value may resume leadership here in the short term. So that's what we got for you this week. 888-543-3776. If you have any questions or concerns, please have a wonderful Thanksgiving. Thank you for your business. And if you have any questions, please do not hesitate to reach out to your advisor or reach out to our home office. Thank you again and happy Thanksgiving.